For more on the jobs report and possible impact of Fed policy, I want to bring in Roger Ferguson. He is the former Fed vice chairman, someone who's been inside that room. He's been pretty right about what the Fed's going to do throughout all of this. He's also a CNBC contributor. So you saw the numbers, sir. What was your reaction as you were watching those pour through?
Yeah, my reaction was it's roughly as expected. We know that there are many signs that the job market is cooling, but I wouldn't say it's a cold job market. The ratio discussion was right, and I think the unemployment rate at 4.3, while edging up, I don't think is in alarming territory. So I think it's pretty much consistent with the Fed's primary theme, which is perhaps a rate cut in September, may be appropriate. But I'd also say that it's very much a data-dependent Fed. We've got more data to come, so I think the September rate cut seems in place right now. I think the markets are a little ahead on the next two meetings, however,
well, that's
based on
where
this
I wanted
one
to
report.
go with this. So you're saying yes to September, but now that we have two more cuts built in, you're saying maybe not?
That's exactly what I'm saying. I'm not saying a definite no. I think it's too early. I think the Fed itself is very much in a data-dependent mode. People often have also forgotten that, the commentary we've heard from Fed officials since Jackson Hole, I would say, has been cautionary. If the number of people saying not so sure how fast we want to go. And the last official SEP, the so-called dot plot, showed a committee that was pretty divided. So and finally, and most importantly, we haven't had discussion today at all about inflation because that's not what today is about. But those inflation numbers, I'd say, are not necessarily giving comfort to a need for a campaign of cutting just yet.
Well, that's my real question. We're looking, by the way, the Russell 2000's up over 1%, but 1.25% right now. So equities are moving higher on the back of what might be described as bad news.
Well, look, I think it's this, from the standpoint of the markets, they want to hear validation of their expectation that the Fed is going to, continue to be or start to be more accommodative. And so they're building that expectation in. I think maybe a little ahead of themselves. And the fact that the markets themselves are doing well suggests that financial conditions are also pretty accommodative. So I think it's a much more mixed picture, not all on one side just yet. And the markets, I think, are looking for the news they want to hear, as opposed to perhaps the more balanced picture that the Fed might be looking at.
Okay, so dare I ask, are these numbers credible? And the only reason I even raise this is because the president raised questions about the credibility of the numbers last month and, in fact, fired the head of the BLS as a function of it.
Look, I think the numbers have always been credible. The reason there was such a large set of revisions the last time around, frankly, was not exclusively, but in large part because the federal government itself is relatively slow at reporting. That's okay when there's sort of a static federal government not moving much one way or the other. But when we see a federal government on a downturn, the delay in their reporting has an impact on the overall national numbers. So I think the numbers have always been credible, and that really doesn't need to be part of the conversation right now.
Can I ask you a separate question, which is, we saw this hearing yesterday with Stephen Moran, who would be joining the Fed. Very unusual situation where he effectively would keep a job in the administration while he's in this temporary role, and how you think about that personally, but also how you think about how that might impact the dynamic while he's in that role if it is temporary.
Look, I think it's an unfortunate situation. The Fed's independence is now very much on the table with the questions around Lisa Cook and now the new governor nominee suggesting or saying clearly he's going to be only on a temporary leave of absence from the White House. Look, I think it just puts the independence question squarely in front of everybody in a very unfortunate way. And I think you heard a number of senators raise that question. And I think the market should also be paying attention to this. This is, yet another perhaps chip or move against the independence of the Fed that I think is a very disturbing long-term trend.
Roger, you just said the market should be paying more attention. The markets thus far have shrugged at all of this in terms of the way equities and arguably the bond market has moved. Does that surprise you? And what should the reaction be from an economic perspective?
Well, the market has moved ever so slightly, to be clear. We saw some tick up in the 30-year rate. It doesn't surprise me fully because I think the market has gotten itself used to the fact that at the end of the day, you know, after ups and downs and back and forth, perhaps things won't change as much as we fear. And, you know, I think there are a number of institutional strengths around the Fed that the market is still counting on. So I think the market is a little bit in a wait-and-see mode right now. I would just encourage not just the market, but all citizens to be attuned to this. But it is certainly the early days of this drama for sure.